So I recently invested in a stock at IPO, but was that a good idea? Hi, welcome back to the Part-Time Investor. My name's Johnny and this channel is all about my journey into investing into the stock market. So yeah, I recently invested into a stock that had IPO'd on the day it was available, and that, I'll put you out of your misery, that was Rocket Companies Inc. And I'll go into a bit of more detail into them in a little bit, but as I recently invested into a company IPO, I thought I would do a video on what the whole IPO thing is all about and how it works and that kind of thing, because I really had no idea about it. So to start off, why does a company bother with an IPO, which stands for Initial Public Offering? Basically meaning it's the first time that those shares are available to the public. So before a company goes IPO, it's classed as private, and that means you can't go in and buy any shares in it on the stock market. So when a company's just starting out, they'll go to the likes of angel investors and investment funds and say, you know, this is our business, this is the business plan, we're offering X amount of percent to invest in our company, a bit like Dragon's Den, I guess. And they'll generally go through several stages of that investment as they move along. And after a certain point, once the company starts to build up its revenues and become bigger and bigger and bigger, those investors are going to want a way out and way to make their money back, because even though you've invested in a company, even that company's worth more, it's not very easy to sell out of a business when it's private. So if those investors or even the founders want to get a bit of money out of their business, then they need to really go for a public offering. But it's not only so that investors can get a bit of money out, it also allows the company to raise cash that they can then reinvest into the company for one thing or another. Okay, so that's a reason why a company might want to go public. So the next thing they have to do is go and find an underwriter. That'll generally be an investment bank or a couple of different investment banks. And they'll go to them and say, we want to go public, will you help us with that? And they'll then start the process of going through an IPO. And what that generally involves is, one, doing all the due diligence on the company, checking that all their financials and all that kind of stuff are in place, and also involves doing the due diligence on what they think the company is worth. So the initial share offering, how much is that going to cost? And they'll then go and find big investment pension funds, investment hedge funds, all that kind of stuff. They'll go and find them people to buy those shares. So that's called the primary market. So up until now, the public, as in you and I, we still don't really have a look in unless you are invested in a particular hedge fund that then goes and invests in that company. So this primary market is really not open to you or I. And what the investment bank, the underwriter, does is go and finds them, does a due diligence and says, right, we believe this company is worth £20 a share. So let's say in the case of Rocket Companies, it was initially touted at, I think, $20 to $22 a share. And they were looking to sell 150,000 shares. So based on that, they know how much they want to raise in capital. Now they went to all these investment funds, the people that they know in the industry who invest in different things at IPO. And they said, we want to sell you this at $20 a share. We've got 150,000 shares. However, there wasn't enough uptake, so they had to lower the price of the shares to $18, and also they sold less. They only sold 100,000. So at $18 and 100,000 shares, they raised a lot less than they were wanting to at $20 a share and 150,000 shares. Anyway, so that's the primary market. They went and sold their shares to these investment funds. After this point, the investment funds and the pension funds, whoever bought the shares from the company, can then put them on the secondary market. And that's the stock market like the London Stock Exchange, the New York Stock Exchange, that you and I can then buy from. Now they then, at the on the day of IPO, they'll put however many shares they want to sell and begin to sell them. And if there is a large uptake, the shares price will go up, and if there isn't enough demand, the share price will go down. So that's pretty much how it works in a nutshell. But there were a number of questions that I had when I was going through this that maybe you have, and hopefully I can answer them for you, or at least this is how I understand it works. So first off, I was wondering, well, if the company has sold its shares on the primary market, then why does it really care about the stock price after that? Because it's already got its money in the bank. It doesn't make any difference to that company whether the stock price goes up and down. Well, that's not really the case. The company will never offer 100% of the business as shares, so it has always got some left over, and as that stock price goes up, the value of that company goes up. Now, what it can do after that is offer more shares to the market to raise more cash at a higher price, or having a higher value allows it potentially to acquire other businesses and saying our shares are worth X amount, so we can give you a share percentage. It basically allows the company to have more money and be valued higher. So it does benefit it, even though its initial share offering, it got the money, that's done. It's still got a lot of shares left over that will be affected by the rising share prices, that in the future it may want to be able to raise more. So when I bought my shares in Rocket Companies Inc, when it was available on the first day on my platform, which is Trading 212, but also on any other broker you would have been able to buy on the secondary market, I wasn't directly buying from Rocket Companies Inc. I wasn't giving my money to them at all. I was giving my money to the person who'd purchased it from them, almost certainly. And that's something I never really thought of before. I guess when I first started investing in the stock market, I assumed that my money was being invested into that company, but it's not really. Anything that you buy on the secondary market is only trading between yourself and other people, other retail investors, or also other kind of professional investors and pension funds and hedge funds and that kind of thing, from which the company itself doesn't directly benefit, but as you're buying, you're increasing demand, potentially increasing the share price. Obviously you alone aren't going to do that, but many people will be able to raise the share price and indirectly and directly, I guess, benefit the company in question. So that's IPOs in a nutshell. Now on to Rocket Companies and why I bought a very small slice of it. I only bought 4 shares or so. The reason why I decided to invest in Rocket Companies at IPO, which is always a risky business because there's not as much financial information out there when a company goes IPO. They don't have to have produced that prior. They generally have information out there so that investors can decide whether it's something to buy, but there's not that level of information that would be available if that company had been public for many years. But the reason why I decided to invest, and again, only a small amount, is that Rocket Companies is the largest mortgage lender by volume in America. And it's not really Rocket that is the main brand. It's a company called Quicken Loans that Rocket Companies owns. Really, when you're investing in Rocket Companies, you're investing in Quicken Loans. Now, Quicken isn't a traditional mortgage lender. It's what's called a mortgage originator. So that means they get the mortgage, set them up, and then they sell them on to other parties, so generally banks or governments, that kind of thing. And because they're an originator and they don't hold those loans for very long, that reduces their risk to defaulting. So they've got less risk on the default side, which is a potential issue in times like, now with coronavirus and that kind of thing. And the reason why I think they might be a decent shout, at least for maybe the next couple of years, 3 to 4 years-ish, is because although there may be reduced amount of people going for loans or mortgages in particular if they've lost their job, the interest rates in America are at historically low levels. Now, obviously, at historically low levels of interest rates, you're going to get a better deal on a mortgage or a remortgage. So that's likely to keep business ticking along for the next couple of years, and they've shown pretty consistent growth over those years. And what Quicken Loans does is that it has a very nice and easy to use platform, online platform pretty much, so it will appeal to millennials and people who are more happy to deal with a computer than they are with a person. And I personally, I'd much rather just go onto a computer and try and find the best mortgage deal than I would going into and speaking to a mortgage advisor or something like that. I much prefer just to do it online. And I know a lot of other people are the same. So all that packaged together with the low interest rates, which I'm pretty sure are going to stay low for at least the next couple of years, I think that's going to bode well for Rocket. Now, in the long term, if interest rates start to rise, that's going to be an issue. So I've got to keep an eye on that. And I think I've put a timescale on holding Rocket Companies for about 2 years, maybe 3 years, and then I'll look to sell it on. Hopefully it will make me some money in that time. We will see. But given that I'm 4 months into investing now, I will give you an update of my current position and the positions of all my stocks. So if we start from the top, start from the A's, we have American Express. That was one of my first purchases, and that is up 11%. AstraZeneca is down 4%. I've actually got a free share in that, so technically I guess I'm up. Bellway is down 4%. Carnival is up 5.5%-ish. Delta Airlines is up 2%. Diageo, not Diego as I used to pronounce it incorrectly, Diageo is currently down 0.5%. EasyJet is currently up 1%. Intel still down 3%. That's my value buy from my last couple of videos. I'm still hopeful on that. I'm going to be adding into that one. A new entrant into my portfolio is the Invesco EQQ. That's the one that has all the big tech companies into it. It's the NASDAQ 100 pretty much. So it has Tesla in it, it has Apple, it has Amazon, it has Netflix, that's all them kind of things. I've only bought that yesterday. That's up 0.3%. The iShares Physical Gold ETF is up 8%. The iShares S&P 500 Information Technology ETF is up 5%. I'm probably going to sell out of that and put my money into the Invesco EQQ at some point because they're pretty much the same thing anyway. Apart from the S&P 500 has a few of the more risky ones. It doesn't have Netflix in it. It doesn't have Tesla in it, at least for the time being. National Grid, these are my free shares, currently down 2%. So free shares are not doing well for me currently. Although, thank you very much for using my link. If you want to use it, it is down there. I'll talk about that later. Norton LifeLock is currently up 13%, doing pretty well. Again, that was one of my first picks. So my first picks doing pretty well, but they've had the longest amount of time to appreciate in value. Rocket Companies, the new kid on the block who I'm talking about, is currently up 16%. I only put about 60 quid in there, so but 16% is 16%. That's doing very, very nicely for me currently. Royal Dutch Shell down 8%. I think that's one of my worst performers. Under Armour down 7%. That's my free shares. Again, free shares aren't doing well. Unilever up 9%. I wish I'd put a bit more in that. I probably will do at some point. My Vanguard FTSE 100 ETF up 1%. The FTSE 100 is not doing well. That was one of my first buys, and yeah, 1.3% is a little bit disappointing, although at least it's up. The Vanguard FTSE Emerging Markets is up 2.9%. That has come down recently, but I'll probably add into that because I am pretty bullish on the emerging markets. And my Vanguard S&P 500 ETF is up 7%, nearly 8%, doing pretty well. My Visa shares that I bought maybe a month ago now, is up 3%. And Walt Disney currently up 16%. So if we go through that, I think, if I'm right, Rocket Companies at 16%, the new kid on the block, is my best performer. Yes, it is. And my worst performer currently is Royal Dutch Shell at minus 8%. So if we add them all together, I've invested pretty much £4,000, and that has created a total gain of 3.5% and a total return of £143, not including anything that I've sold, which amounts to 20-30 quid, and also not including dividends, which amounts to about 15 quid, and not including any free shares, which amounts to about 100 quid. But they don't really count in terms of my investments. That's just you nice people using my link and get yourself a free share and getting me a free share. So thank you very much for that. I hope you enjoyed this video and got a bit of information maybe you didn't know about IPOs. Maybe you did, maybe you hated it. Let me know in the comments. Obviously, don't tell me if you hated it. Well, you can do. Give me a thumbs down if you want, if you really disliked it or you thought I got everything wrong, or just let me know if I say anything wrong. I'm always happy to learn. That's just how I like to think about how an IPO works in my own head and the few questions that I had. If you want to subscribe, please do. I'm trying to make a video every week. It's not happened. I'll just make one when I can. It seems to be every two weeks-ish. Every week, every 2 weeks. But you know, you can hold on for this grade A quality content. As I said, I've received another few shares from you very good people using the link below. If you are looking at setting up a Trading 212 account, and I can say that I have found it pretty good so far. I'm a newbie investor. I didn't have a lot of money to invest up front, and Trading 212 is good for that. If you are wanting to invest a lot more money or in mutual funds or something else, then go use something like Hargreaves Lansdown, AJ Bell, something else like that. I'm not saying you should definitely use Trading 212, but if it's the platform for you, you may as well get a free share worth up to the value of £100, and you can do, because I have received a AstraZeneca share worth £94, so they are out there. It is possible to get them. Then please use the link below, and that's what you have to do. Sign up with £1. There you go, you'll get yourself a free share, and I will too, and it will be very, very appreciated. Anyway, that's it from me. See you later.